Once again, welcome to the book launch and discussion of blockchain and distributed ledgers, mathematics, technology, and economics. A few housekeeping notes before we start. Please have your camera off and mics muted. There will be Q&A and comment session after the talk. Feel free to post questions in the chat box or raise your hand in Zoom. Also, this event will be recorded and posted online. Good morning. Today, we're very fortunate to have our guest speaker, Professor David Gershon, and authors of Blockchain and Distributed Ledgers, Dr. Alex Lipton and Dr. Adrian Chikan. They will be sharing the insights into distributed ledger technology and its applications. Our special guest, Professor David Gershon, is the founder of the Gershon FinTech Center at Hebrew University of Jerusalem. He is Israel's leading expert in FinTech. In 1999, he founded Super Derivatives, a leading financial data vendor, and was its CEO until it was acquired by the Intercontinental Exchange in 2014. Previously, he was global head of currency exotic options at Barclays Capital, following a career as a prominent derivatives trader on Wall Street. Dr. Alex Lipton is co-founder and the chief information officer of Sela, partner at Numeria Financial, visiting professor at Hebrew University of Jerusalem, Connection Science Fellow at MIT, and advisor to several fintech companies. In 2000, Alex received the inaugural Quant of the Year award, and in 2021, the Buy-Side Quant of the Year award by Risk Magazine. Dr. Adrian Chikan is founder and CEO of Metical, a leading provider of security infrastructure for digital assets and a software engineer specialized in high-performance computing and financial engineering. He has been an active member of the fintech community since 2012 and advised numerous financial institutions on DLT, cryptocurrency, and decentralized finance. And now, I would like to hand it over to Dr. Gershon, Dr. Lipton, and Dr. Treccani.
Shall I start? Okay, so first of all, thank you very much for inviting me. It's really an honor for me. FinTech has been undergoing dramatic growth in the past 2 years. Of course, it's been growing for more than 2 years, but the last 2 years since, I would say that COVID-19 started, we've seen, some people call it explosion in the area of FinTech. And this enormous growth is happening in several areas, but the area that is undergoing I would say the fastest growth is the area of payments. In the area of payments, we are seeing some areas that are, or some segments that are dramatic. It's of course, the area of treasuries and payments, receivable, all these transactions, the area of banking, which is also related, but still technologies and so forth, and the area of point of sales and everything that is connected to the closing circles of payments. And blockchain is certainly one of these, or cryptocurrencies is related to this, to the areas of growth. And we are seeing there enormous growth that is a result of a few factors. One factor, of course, is a continuation of something that we have seen in the last few years, the growth of cryptocurrencies and growing usage of blockchain. But also we are seeing some dislocations in the financial area that also affect the role of blockchain and cryptocurrencies in this space. And one of the things that seem to be promising is the creation of a new asset class. One of the reasons that institutional investors are being attracted to adding cryptocurrencies to their portfolios. This is something that is growing in a very fast pace. And despite some negative reaction from China and India in this area. For example, in the States, we see that this effect is still continue to grow. Unlike other areas of fintech that are really simple and self-explanatory, everybody can understand what things do. In the area of blockchain, it's a little bit more difficult. Most people don't quite understand what blockchain and cryptocurrency mean. They only have a high-level understanding, and some of them have the desire to get into the space, but they lack the tools to be able to really deal with it. And even when it comes to companies that try to provide tools for the retail market to use cryptocurrencies as a simple investment vehicle, still they lack the knowledge and the capabilities to do that correctly. The book that Alex and Adrian wrote, in a sense, I think there is no other way to say but an encyclopedia for blockchain and cryptocurrencies. Certainly the most concise book that has been written on this space, I think, provides a wonderful and very useful tool for whoever is interested to get into this space, or those that are in the space and are trying to develop tools that are more sophisticated and they need to understand how to do it properly. And this book provides the tools and the knowledge to bring everybody up to speed. It's written in a language that every intelligent person can understand. And it offers really a guide that allows everybody to get into the space and be up to speed and do the most sophisticated things. Blockchain in general it's a technology that we have been experiencing for several years already, and more tools are being developed around it. The most recently growing in popularity is the DeFi, the decentralized finance, and many people believe that this is one of the areas that will have the highest growth in this space once tools will be added to this space, and more technology will be accompanied with this, and self-build investments will happen there, and so forth, algo trading, and so forth. And while we are not sure about the future of how deep these technologies will get into our life, are they going to really take over what we are seeing now? Are they going to be an additional venue? Are they going to be competing with other governmental initiatives? It's hard to say at this point, but certainly this technology is here to stay, and it's very important that as many people as possible will be able to understand how to use this technology and to use it properly, and not just use tools that are available here and there without understanding what exactly they do, or use them in improper way, and so forth. So from this perspective, I think that the book has done a tremendous service to the community by really opening the door to many people in the fintech space to understand how to use blockchain, how to combine blockchain technologies in their initiatives, and how to use it in an optimal way. And of course, also understand where the whole thing is going. There are wonderful things in this book that really hints the direction that can evolve from this point. So thank you very much for me.
Thank you, David.
Thank you.
Thank you, David. Yes. First of all, I want to thank David for this very kind and detailed introduction and an insightful description of what Adrian and I were trying to accomplish. Second, I want to thank Adrian for being such a good co-author and working relentlessly over a couple of years in spite of his other responsibilities, and the fact that he also got a son during the process of writing a book, right? So it's all has been a tremendous journey for me personally, and very enjoyable. Not without obviously disappointments here and there and whatnot, but overall I found it quite an exciting thing and a very welcome diversion from the vagaries of this COVID situation and lockdowns and whatnot, right? So as David said, this blockchain technology is coming to is coming to maturity by now. It has been around for quite some time already, about 12 years or so, and started with the groundbreaking white paper written by an unknown entity under the pseudonym of Satoshi Nakamoto, whoever they might be, or he or she might be. And this short white paper, really no more than 10 pages, really launched a blockchain revolution. And right now we see that this technology covers a lot of different areas, right? So the most obvious one, so to speak, in your face, if you wish, is of course, cryptocurrencies, which go up and down and create enormous excitement in the community, both on the side of the proponents and the side of the detractors. Of course, obviously during a different period in the cycle. So when they go up in price, the supporters rejoice, and when they go down, the opponents say that this is the last hooray, and so they will disappear in a few weeks' time, and that sort of thing. Adrian and I tried to struck neutral stance in this regard, neither being partisans of cryptocurrencies, nor being, enemies, but rather just describing what they are and how they evolved over a period of time. So what types of cryptocurrencies available, including, the coins and tokens and whatnot, etc., etc. But in our opinion, the real potential will be shown when further development take place, including, for example, distributed finance, non-fungible tokens, all kind of auxiliary non-financial applications to identity, to to the supply chain, to trade finance, etc., etc., etc. So the potential applications are numerous and really exciting, as well as in order, as David correctly said, that there should be correct tools, not only from a conceptual standpoint, but also from a practical standpoint. And from that perspective, the book particularly benefited from the experience Adrian has firsthand as a CEO of a preeminent security company in this space, because surprisingly or not, security of blockchain transactions at the level of the private and public key pairs and private public key infrastructure in general, this security issue has never been resolved in full, and it's a work in progress, and that's where Metaco is contributing a lot. Also, the book benefited somewhat from my personal experience as a co-founder and CIO of Sila, because at Sila we do have a stable coin, which seems to be a better tool for actually performing transactions within the existing economy, rather than trying to create something completely different in the form of simultaneously solving the trust problem in the blockchain environment and redefining the sort of the currency at the same time. So it's probably more practical to do it in two stages. And that is what the book is about. So in my mind, it covers many bases. I wouldn't be too bold to say it covers all bases, but it covers many bases. And also we tried very hard to make sure that the book will be available to both people who kind of have good mathematical background and do have the knowledge of cryptography and other paraphernalia, and the people who want to learn them on the go, because we did include several chapters where specifics of cryptographic protocols are discussed and so on and so forth. So you can basically, if you wish, we wanted to get, you know, kind of to let the reader become a master of fine detail of a big picture, if you wish. So I'll stop here and let Adrian to share with us his thoughts about the book.
Well, thank you, David, and thank you, Alex, for this this great introduction. And of course, after this this beautiful introduction, it's always hard to add so much substance. But I want to say that it's been a journey to which we've gone writing this book, and it is the consequence of a conclusion we had that although there are already books on the market and there are already pretty good articles online on the topic, we could not identify an objective and exhaustive, at least exhaustive to the extent that we wanted to cover, written documentation about blockchain technology and its various applications. We wanted to be able to provide a book that would be self-sufficient, that would start with the history and the basics of why blockchain was even invented, then to get into how it works, and then how it is relevant. And this relevance part is something which we have tried to dive into, how it actually can be used in practice to have an impact on the economy, to have an impact on many of the interactions that we have today, and also to give this future-looking view of how it may be used in the future. And so remaining critical, you know, as you can imagine, I've been myself now almost for 10 years in this ecosystem of blockchain and cryptocurrencies, started trading cryptocurrencies in 2012 when the price of Bitcoin was below $30 and there were gigantic market inefficiencies and arbitrage opportunities. And I've been therefore a big proponent of this technology since then. But what we tried to achieve with Alex was to put the feelings aside of the writing and remain as objective as we could, being very explicit about the pros and the cons of these technologies. And also when there was a con, find the, explain also how these weaknesses or deficiencies could be resolved or improved over time with some of the research that is happening today and some of the innovation that there is on the market. I believe today with the book, we've been able to gather on one side, a very high level, but still precise description of what this technology is about and where it is going and what impact it may have, but also a very technological angle. As Alex mentioned, we have a whole chapter on cryptography. So if you're able to survive this chapter, you would probably be able then to do some basic cryptography up to the most advanced cryptography with comfort with asymmetric encryption, with digital signatures, potentially with Merkle trees, with some elements of zero knowledge cryptography. So things which you would not necessarily be facing if you were starting with articles online. But we also go one step further and look at the economics and the finance elements of it with a statistical analysis, with essentially comparison to the traditional markets and trading properties of these assets, so that the book fits, I would say, a reader that would be more on the banking side or potentially derivative side or economic side, but also readers that would be either very technological and therefore would be able to get into the details on the cryptography side or the engineering side, or potentially readers that simply want to have a good understanding of what is happening on the markets and how they can then consume this technology to build more services. I will conclude this first statement by saying that I believe we are still very far from understanding the full extent to which digital assets and blockchain is really going to impact our lives and the economy as a whole. I believe Alex will agree that despite the fact we believe we have been as exhaustive as we could for this first iteration. There is a good chance that we may have to write a second tome, a second book, or to complement this one with new chapters, as this very fast moving industry makes our book a book which becomes incomplete. Personally, I believe one topic which is going to grow and accelerate is going to be decentralized autonomous organizations, which are in a way the equivalent of companies or corporations, but in a decentralized way. I believe this is one of the biggest topics that will materialize over the next 2 or 3 years, potentially also having gigantic regulatory implications and legal implications. And although we do cover this topic in the book, I believe we're still very far from understanding to what extent it may be disruptive. So I will stop here for this introduction, but thank you, David, also for helping us for this session today.
Thank you. Would you like me to ask the authors some questions?
Yes.
Okay, wonderful. So if you don't mind, I'll start with Alex. And I would like to ask you something that looks trivial to most people, but I think your deep understanding will reveal some layers that many people don't see. So Alex, what do you think is the role of Bitcoin in other cryptocurrencies?
Well, I would say it's a catalyst of, forthcoming revolution, so to speak, right? So the fact that money has been derived from law had been emphasized by Aristotle more than 2,000 years ago, right? So that was his main, kind of view of the money. And in fact, he was linking the Greek name for money, numisma, to the Greek name for the law, which is nomos. And so, but with the arrival of Satoshi Nakamoto, this Aristotelian view, which survived and actually was correct for 2,000 years, had been, if not overturned, but at least augmented with the idea that money had actually be derived from something other than law. And in this case, it's just from enthusiasm of people, so to speak. It's quite surprising to see that people can create something having which becomes quite valuable, just on their own volition. So from that perspective, if you think it's a gigantic social and economic experiment, which I am very keen to see where it will get, it brings the best and the worst from people, and so it does not leave anyone neutral, right? So people are either wildly enthusiastic or wildly dismissive, whilst in my mind the truth probably is somewhere in between. So one statement which Adrian and I are making in the book, and which I want to emphasize, is that Bitcoin per se has no value, but it does not mean that it actually doesn't have price. So essentially, it's the fact that something has no value per se actually implies something very different, that it can have any price. And so from that perspective, the fact that it's so expensive right now is actually a reflection that it is predominantly a supply and demand type of derivation. And in a sense, Bitcoin is from balance sheet perspective, it's a pure asset, so to speak, right? So in contrast to fiat currency, which is always having asset and liability side, Bitcoin in that regard is a pure asset. So it's a very interesting situation. Whether I think that Bitcoin is the last word in terms of cryptocurrencies and whatnot, I don't think so, because it is not without very severe deficiencies, of which one, people kind of argue back and forth, but in my mind, the fact that it consumes so much electricity is a drawback. And of course, I know that some people say that it is all green and so on. That's not quite true. Of course, kind of until very recently, the main producer of Bitcoin, as many other manufactured goods, was China. And there, it was produced out of brown coal, which is the worst polluter. And, like in this general area of Inner Mongolia, and far away from from everywhere else. But so I think that there would be other currencies, and in my mind, particularly promising direction. If you want to set aside this kind of this area where people really want to develop something for themselves outside of the existing system, and which is commendable thing, but it's sort of separate. If you want to actually look at things within the system, then I think that crypto stable coins in particular, as a kind of very sort of contemporary solution to mapping existing fiat currencies on blockchains, have a lot of promise. As I already mentioned, and in the interest of full disclosure, will repeat, our company Sila does have its own stable coin and whatnot. And then, of course, as a logical development, it might very well be that central bank digital currencies, if indeed they are ever released in the wild by central banks, because as the name suggests, that has to be done at the level of central bank, would be a major game changer. Because if you look at the internet protocols, you will see that there was never a clear understanding of what money and identity on the internet is. And in fact, there are placeholders in the original protocols from the 70s and 80s, but they were never filled. So it might very well be that this type of cryptocurrencies might actually solve this issue. So to summarize, I think that Bitcoin is super interesting. Whether it's the last word, I doubt it, but it's at least very interesting to observe. Stable coins are very promising, and in fact, I think they will proliferate. And then so central bank digital currencies would be, if they were ever to be implemented in earnest, would be a real game changer from the standpoint of being able to move value on the internet freely.
Okay, thank you, Alex. And before I go to Adrian, one more question to Alex. So, Alex, do you think that smart contracts can really make finance decentralized? And what is the role of automatic market makers, do you think?
Wonderful. So you are asking some of the very interesting questions, and in fact, something which I am actively working on with Arthur Sepp, who is actually present in this discussion, who just last Friday, I believe, joined Signal Bank as the head of structure product and stuff like that. So congratulations, Arthur. Anyway, so what I want to say is that finance, the way we understand this, it's basically past this best buy date. It's too complex, right? The situation is that people were afraid of banks which are too big to fail. Reality is that these banks navigated their ways and sort of stabilized the act after the global financial crisis, but in the process they actually became bigger rather than smaller, and in some sense they became too big to manage. That's even more worrisome than being too big to fail. And the fact that some banks are kind of better managed, some banks are kind of really not managed very well at all. And so I'm not going to name too many names, but recent debacles at Credit Suisse really show that this control feedback loop is broken in some institutions, because they just, parts of the institution do not know what other parts are doing and cannot really put things together. Enough is to say that, this Archegos debacle, if you balance kind of left and right side of the balance sheet, so it brought about $20 million in profit for 2020, and the loss was about 5.5 billion in 2021. So clearly these are completely unbalanced type of activities and so on. And so from that perspective, it is not unreasonable to try and use some different paradigms to see if we can change the operation of high finance, which is one of the most complex activities humankind has known, to a different level. And so from that perspective, I think that consensus as a service providers, such as Ethereum protocol or newer protocols like Cardano, or Solana, and some others which are coming upstream, can be used in order to automate and kind of simplify the flow of funds and the activity of participants in the financial markets. Make no mistake, smart contracts are, it's a marvelous name, a triumph of marketing. In reality, they're not that smart, so they consume a lot of collateral, and also they're extremely unforgivable, because if there are bugs within the contract itself, they cannot be changed, as Adrian, I'm sure, knows well better than I do. And so this is a development in its sort of early stages. There are many buggy contracts, and some contracts which are deliberately buggy, some which are buggy just because it's the nature of software development that people tend to have bugs which they cannot identify on time. But nevertheless, I think that this is definitely developing in the right direction. So the protocol itself provides consensus as a service. There are issues with that as well, because occasionally the services can become prohibitively expensive, right? So when Ethereum, for example, goes in price and there are no kind of suppressing mechanisms, simple transactions can just become too expensive. But for that, we have newer protocols which seem to be cheaper, at least at this stage in time, like, as I said already, Cardano, Solana, Zilliqa, and others. And so that is very, very promising in my mind. And then one area which is particularly interesting is application of automated market makers, which is specific smart contracts which simply allow you to exchange one asset to another in an algorithmic form. So to fiat. That is something which I think is particularly promising. It can change the way the entire Forex industry, which turns around about $5 to $5.5 trillion worth of value every day, can switch to something, some new modus operandi, which is promising. So to make a long story short, I am a big believer in simplification and algorithmization of finance, and I hope that smart contracts and automated market makers will play the kind of designated role in this process.
Thank you. And a question to Adrian. Adrian, I want to ask you about your view on institutional grade security. What do you think about NFT, the non-fungible tokens? What is the view in the book about institutional grade security?
Absolutely. So if you look back a few years, you'll find dozens of examples, if not hundreds of examples, of companies which have been subject to hacks, thefts, or other forms of security failures. And the reason for this is that cryptocurrencies and digital assets and blockchain technology as a whole relies on cryptography and on a concept called digital signatures, where you're not legally owning your assets, you are cryptographically owning your assets. And therefore, the only proof that you have that you own these assets is by using what is called a secret key. And this secret key is like a long password, which uniquely defines your right to consume the assets and potentially transfer them. So as you can imagine, this long password called a secret key is particularly difficult to manage, because if you put it on a piece of paper, you may lose it, it may be destroyed. If you put it on your hard drive, somebody could steal it, it's not very difficult for a hacker or even your neighbor to come on your computer and take this long key. We've seen examples both on the retail and the institutional side that actually users and individuals may not always be ready to have this responsibility on their own. You always want to have complete freedom, and here it's the libertarian speaking. You're very happy to be free to manage your own assets with no intermediation, but you should always keep in mind that with all of this freedom comes a lot of responsibility also, that there is nobody to call if you lose your key and therefore lose your assets. So when we speak about institutional security, we're speaking here in a context where we understand that there is some form of an adoption by the traditional players on the market, let's say banks, custodians, but also some more recent, more newer or more contemporaneous companies that are looking to provide a professional service in which they actually manage the assets, they manage these keys, and you therefore consume and invest in cryptocurrencies and consume smart contracts through an intermediary that has the professional tools to do so. And I'm not saying it's better or worse. I'm saying it's simply a different model to consume what digital assets have to provide. A model which is maybe further away from the ideal initial ambition of Satoshi Nakamoto, which was very much, be your own bank paradigm where you don't rely on any form of intermediary. But at the same time, which is a pretty good trade-off for individuals that, or even companies that do not want or cannot afford the risk of managing their own assets. I'm saying it's a good trade-off in the sense that many of the institutions that are moving in this market and offering such services, let's say banks, they are actually not forcing you to do so. You can use their services, and generally it's a full reserve model where they have actually 100% of the assets that you've deposited at the bank. And if you decide that you're no longer satisfied with the service, you can withdraw these assets and either deposit them at a different bank or potentially deposit them on a piece of paper that you're managing by yourself. So it's still a model which is rather open, but which comes back to something which we're more used to when we think about traditional assets that we normally leverage through the banking system. In fact, today, you already have kind of this option to have cash under your mattress, and you can do it. It's not practical, if you have too large amounts, the regulators may kick in and you may have little questions about how you intend to use this cash, but you still have the technical capability to put a lot of cash under your mattress, and you would therefore be your own bank, quote unquote. And so this principle is not new. You can do it, but in general, you still prefer relying on your bank for the management of some of your assets. I believe institution-grade management of digital assets is really about providing a professional infrastructure for the management of these keys and for everything that's around the management of the keys, whether it's the governance, who is authorized to trigger the payments, how do you secure the entire process, and how do you integrate this into reporting capabilities and tax reporting capabilities that ultimately you as a citizen will be able to use to make your own reporting to the government or potentially as a company to your auditor. Now, jumping just on the comment of NFTs, because you brought NFTs, and NFTs are about non-fungible tokens. So what is a non-fungible token? As you know, now for many years, probably since 2014, cryptocurrencies have generated a lot of new ideas. So cryptocurrencies have been not just about using so-called native cryptocurrencies like Bitcoin or Ether, but also using the blockchain technology to issue new currencies, new form of assets. And stable coins, as Alex was referring to, are just one example. You can issue coins which are pegged to an underlying asset class, which could be dollar, euro, which could be gold, a precious metal or something like this. But you can also issue tokens which refer to much more elaborate kind of assets. It could be a real estate, a building, or it could be a Picasso painting or a car or intellectual property. This is what tokenization is about. And NFTs are kind of a subset of tokenization. It's the idea that you're not creating a fungible token where you take this building in Manhattan, New York, and that's worth 100 million, and you tokenize it into a billion shares, a billion small tokens, and everybody can buy a very tiny particle. Here you are taking this NFT non-fungible, and you have a single token to represent the ownership in a single thing. And that single thing generally is going to be intellectual property, which could be, the rights to a song, the rights to a picture, the rights to a movie, the rights to a sequence of a very short movie. And surprisingly, it has made this market of intellectual property much, much more liquid, to a point where any individual or any small company can create a sort of a right to ownership of the intellectual property of a little picture that it would have created, or little movie that it would have created, issue an NFT that corresponds to it, and have immediately a primary and a secondary market existing for the ownership of this property. So I think NFTs, we are just at the early stages again of the many applications that are appearing every day. Some which are on the provenance side. How can you secure that luxury bag or luxury item is an original one? The NFTs are very much used for this, but also many use cases which may be outside of obvious. For instance, one which could represent the ownership of your house, and you need the NFT to open the lock of your door, things like this. So again, this is a fast-moving train, and in the book we try to give some examples of where we are and where we're going. But as I mentioned already, I think Alex and I, we still have a lot of maintenance work to ensure that we are covering many of these topics in the future.
Thank you very much. I don't have more questions. I just wanted to say one comment. In March, Alex and I organized a 2-day workshop on the latest development and the current status of blockchain and cryptocurrencies under the Gershon FinTech Center of the Hebrew University, and all the lectures are recorded, and I see lots of people today, and I wanted to say that those of you who are interested to listen to these lectures, they're all recorded, and you can hear them free on the website of the FinTech Center. So if you're interested, first of all, you can Google it, and otherwise you can just contact us and we'll send you the links. And it covers really, as I said, we chose all the subjects very carefully, the latest things and the hottest things in blockchain and cryptocurrencies. So thank you very much. And I strongly recommend all of you to read the book. It's really a wonderful book. It's very concise, easy to read, and really, as I said, really, really good book.
Thank you, David.
Thank you.
Thank you, David.
Now we'll open the virtual floor to questions and comments. You can send your question in the chat box or raise your hand in Zoom. Let me start with a question that was submitted by Brendan Cohen. So any thoughts on government regulations on cryptocurrency and the opportunity of decentralized exchange? So classic question of centralized versus decentralized.
Okay, shall I try? So thank you, Brendan. It's an interesting question. So I think that a certain modicum of regulation is really needed, in this field, so that it can become mainstream. That sort of goes without saying that you want to provide a framework which will allow to solve some of the problems related to know your customer, and sort of most of the problem related to anti-money laundering and other things of that nature. That certainly is true. And so that question being answered, whether one can switch from centralized to decentralized exchange, it's probably going to happen at some point, because in some sense the existing financial market infrastructure was created in the 70s and 80s, and the process of switching from paper transaction to digital transaction, but it was a sort of a very, very close reflection of how things were done before manually, so to speak, with paper and so that sort of thing. So it is dated. Besides, to be perfectly honest, even though there was a tremendous push from the regulators after the global financial crisis to move trading in derivatives and all other products which were over the counter before to centralized exchanges because it was deemed to be more stable. There is an issue there, right? So of course, at the sort of normal level, a centralized exchange is quite stable, right? So there are several layers of defense, starting from, of course, variation margin to initial margin to guarantee fund to a kind of open-end ability to collect additional funds from general clearing members and so on and so forth. So from that perspective, that is quite stable. But if, God forbid, and something really serious happened and such a centralized exchange were to collapse, then, which I hope it will never happen, but we have seen many things which we expected never to happen. So that would be a devastating blow to the economy at large. So from that perspective, on the one hand, you sort of, it's a general kind of dilemma whether or not you put all your forces in one place and then fortify it as best as you can, or you spread your forces around and sort of try to make things robust by virtue of decentralization. So from that perspective, decentralized exchanges where there is no central party, there is no guarantee fund and initial margin and whatnot, it's an interesting dilemma. So essentially, both models try to solve delivery versus payment problem. And I think that if you have instantaneous delivery, right, and so if delivery versus payment happens instantaneously on both sides via smart contract, that solves the problem, right? So the kind of the centralized model also solves this problem, but by virtue of novation. So basically, from buyer, it doesn't go straight to the seller; it goes to the centralized entity, and then from the centralized entity to the seller. So whilst the decentralized model can become very immediate. So from that perspective, I think that if and when technical aspects and are resolved, as well as regulatory status is made more robust, these decentralized exchanges will come into fore. And I understand that in Switzerland, for example, SIX is already performing a lot of decentralized activity as it is. Right. That would be my answer. Adrian, do you want to?
Yeah. Do you want to add anything?
No, I think it's very complete, and I see we have quite a few questions. I'd be happy, to respond to another one.
Okay, great. Okay, so the second question is from Jared Kioma. What are your thoughts on Ripple, success or failure?
Alex, you know what? You can answer this one too, because I know you have opinions about it.
Yes, I'm not an enthusiast, a partisan of Ripple at all. So I honestly, the reason why is that I think that it is lacking in revolutionary spirit, quite frankly. I mean, I find this a rather kind of modest, proposal, not at all on par with, say, Bitcoin or Ethereum. And I think it probably has its, space, and, it should be there, definitely. But I'm not wildly enthusiastic. And in fact, we do have a chapter about Ripple in the book, and you can see that, this lukewarm attitude is probably reflected in this chapter as well. So the other thing with Ripple is that nobody knows whether or not it is a security, and there is a kind of ongoing legal battle between Ripple on the one hand and the Security and Exchange Commission on the other hand. And I have to say, I do see the point of SEC in this particular instance. There is something to be said about, something which is pre-mined completely and can be issued at will by the originators of the project, that it is a security. So, and if it is, then of course it has to be regulated completely differently, and then there would be a major issue. I'm sure that the people who developed the Ripple have a different opinion, and they are, going to legal fight. They are well endowed with funds and so on, so they can afford to argue against SEC on equal footing, and we will see what happens. So, yeah.
Okay. I see Julian Phillips raise a hand. Julian, please unmute yourself and ask your question.
Hi, thank you very much. Yes, I also put the question into the comments, but I think I wanted to pick up on two topics which I think are related, which Alex already mentioned. This is I guess, links to one of my grave concerns about many cryptocurrencies, not least Bitcoin, the hugely damaging proof of work concept, which is sort of generating huge energy consumption. And is there a viable alternative to proof of work which actually already exists but simply requires adoption? Or is the author's views that more development is actually needed to come up with something which is an alternative to proof of work and not equally stupid like proof of storage or something else ridiculous like that? And then a second point, which I do think is really related, which is there a viable alternative to stabilizing crypto value without, a sort of a gauche or, feels like a bit of a cop-out approach of linking it to a legacy currency or physical asset, which, feels a little bit like, a cop-out, really, in some ways. And do the authors actually think that these things are linked? Because they do seem to me to be quite linked, but maybe I'm wrong and happy to be disabused of that notion.
So Alex, I'll give you the first shot. So
absolutely. Please, it's your turn. Yeah, go ahead.
Thank you. To start with the first point, and I believe for the first point, proof of work versus everything else, there is both a purely technological argument to it. Can we do better, whatever the metric, whether it's less energy or faster, etc. And then there is I think, as a complement to it, a philosophical argument, or which we could call a political argument, which is yes, it is a disaster in terms of energy consumption, but then must we put this in the balance of the utility that it is providing? Because one thing I don't like to do, and this is always a source of big debates, but it is to say, well, in absolute terms, Bitcoin consumes a lot of energy, therefore it is bad. I believe it is very important to say Bitcoin consumes a lot of energy. This is a fact, but potentially provides a lot of value in exchange for it. And you have to put this in the balance, in the sense that as long as you don't do it, then you would be banning a lot of things, or let's say criticizing a lot of the things that are on the market today, and potentially you would be shutting down governments, shutting down the banking industry, shutting down the trains, all of this, because they do consume a lot of energy also. But we tend to accept that it is for a good cause, because they do provide a lot of service in return. So the question now, once we start with this, is there a viable alternative to it? If so, then I believe we all agree that then it is not great that proof of work with Bitcoin consumes so much, if we can do better for an equivalent service. And I think the short response to this is that there are already quite a few attempts at doing so, and some of them are successful. Proof of stake being the main alternative to proof of work. Essentially, proof of work, you vote on the evolution of the blockchain with pure energy consumption, so you have electricity being burned. Whereas for proof of stake, you vote for the evolution of the blockchain with your wealth. So the richer you are, the more you can vote, if I can say like this, on the future of the blockchain. And so they tend to be comparable on some metrics. Proof of stake has some advantages on the performance side. It is easier to scale proof of stake blockchains than proof of work. However, it is quite often forgotten or left on the side that proof of work has some advantages over proof of stake, in particular in case of a black swan event. Let's say, for instance, that there is a persistent disconnection between two sides of the world. Let's say China entirely disconnects the internet and the rest of the world continues using Bitcoin. Then you have two forks of the same ledger, which both are valid. And if they suddenly reconnect, proof of work would immediately resolve this consensus and select a unique fork as being the main one. Whereas if you are on a proof of stake chain, if you have this kind of extreme events like a black swan event where it's completely disconnected and you have a partitioning, what is called a split brain in the engineering, engineering community. If you have this split brain and it's persistent, when it reconnects, you will have no way of having a consensus about which chain is the right one. So it's less resilient to these extreme events. Now the question is, are you willing to pay the price of proof of work for this resiliency? I think the community around Bitcoin would argue that yes, it is in fact its biggest value. The value of the Bitcoin blockchain is its resiliency to extreme events, but clearly it has also so many weaknesses. It's not really scalable. It consumes all of this energy that the proponents of more modern frameworks like proof of stake would very much argue that proof of work has been today and should not remain the de facto standard. Now, to answer your second point, at least partly, and here Alex will also be able to help me because he has a lot of experience with this. There are many ways you can create stable coins or at least asset indexed tokens on the blockchain. And the easiest way to do so from a technical point of view is to link your, let's call it stable coin or asset-backed coin to a real world legacy coin. Let's say you have dollars in a bank account and you create a token and you say, well, one token in the blockchain is going to correspond to exactly $1 on the reserves I have in my bank account. And this is absolutely possible, and there are plenty of initiatives doing this, like USDC, like USDT. But there are also other ways to doing that. And I'm just going to mention one, which is what a stablecoin called DAI, D-A-I, so DAI is doing today, which looks very much like a CDO, a collateralized debt obligation. So you have the assets and the liabilities, and in your assets you have a lot of collateral, which is going to be normally Ether, but it could be any kind of volatile assets. You over collateralize your smart contract with a lot of this Ether, and on your liability side, you issue tokens which are backed by these volatile assets. Let's call it Ether. And the only thing you have to do then is to have some form of a data feed that's called an oracle. That's defining from the outside to the blockchain what is the current exchange rate, so that you are able to essentially set the value of that thing and have the proper exchange rate baked in the model. So with this approach, interestingly, it is much more decentralized. You don't need to have dollars or gold or silver or whatever asset in the real world that is backing your contract. It can be fully decentralized to the extent that you still need this data feed defining the exchange rate, but you know that the value of your asset is only guaranteed by the over collateralization of something else. Of course, then we get into the other question of how resilient is it to black swan events, to the kurtosis and the negative skewness that we observe in asset prices. Is it going to survive massive drops in the collateral? I would say that the last few crashes that we've seen on the market, in particular last year, have actually seen this stablecoin remain stable, which is a good sign. But everybody said the same thing about the banking system until we got to 2001 and 2008.
Thank you very much.
Okay, here is the last question for the event. So from Abhishek Bhatt, do you think the application of the distributed ledger technology in areas that do not require a great deal of encryption of information and also a certain degree of central governance is absolutely useless?
Well, Abhishek, you're putting, kind of things in a very specific sort of channels. Well, I would still think that some elements of blockchain, perhaps not a fully blown, like proof of work type of arrangement, but a certain private blockchain, and which is with integrity maintained by some simple tools like notaries, or that sort of thing, or designated validators. It still might be a good solution. First of all, it would be much cheaper, and second, it will work much faster, and still, it will add a certain modicum of additional layer of resilience and things like that. So I would say, like for instance, say this Estonian e-road, an example of an attempt of a small country to digitize its entire sort of operations, so to speak. Even in this instance, where in some sense everything is centralized and so on, this elements of blockchain which are being used by Estonian e-road are very, very useful. So basically, I would say you shouldn't be a maximalist and try to throw everything in one pot, but selectively choosing advantageous inventions associated with blockchain. You can improve your efficiency even if things are working as they are. Also, given the situation with data privacy and things like that, I think that in the modern world, everything actually requires a certain level of encryption, because it seems like there are too many prying eyes on all sides looking for data, which in itself might be perfectly innocuous, but an aggregate can create a certain, potentially dangerous situation. So that would be my answer.
Adrian, you have anything to add?
Well, I'll just conclude on this point by saying that one of the biggest values of blockchain is the creation of a form of de facto standards, and aligning very versatile, very fragmented markets around one way, let's say just a few ways of doing things. If we think that SWIFT has value because it created standards in many of the financial interactions, even for centralized use cases, I would say that this is also true for blockchain and smart contracts. And very much agree with Alex that it has also revealed many use cases for inside the company, within the company, and in closed environments, potentially which don't leverage directly the public blockchains, but potentially leverage more private versions of the same blockchains, and then create gateways towards the public chain so that you are actually compatible with the de facto standard. So I don't believe it has no value for closed use cases. I believe it does have some. Clearly, it is not as much as for use cases where you actually want to open up, which is why blockchain was created. But I would really say and emphasize that blockchain has created ways of standardizing digital assets and financial interactions. And I believe this value is also relevant in the context of closed environments.
Okay, thank you. Thank you, Alex, Adrian, and David. We have come to the end of today's event. We encourage everyone to give this book a read, and we're offering a 20% discount to today's attendees. The discount code is on the screen and it can also be found in the chat box. The book is also available on Amazon. It has been a delight to have all of you. Goodbye.
Goodbye.
Thank you very much, and congratulations again for the book.
Thank you.
Thank you, David.
Goodbye, everybody.